Over the past few months, we've fielded a lot of questions about asset allocation and the role of real assets in portfolios. We've noticed that investors have a preference for broad equities and private assets driven in part by recent experience. However, when it comes to asset allocation and the tendency to stick with yesterday's winners at the expense of tomorrow's opportunities, we remind investors we've seen this movie before. Consider the last decade. Global equities delivered annual total returns of over 10%, with U.S. equities returning more than 13% annually. Private assets also saw impressive double-digit returns while reporting extremely low volatility. In contrast, listed real assets like global real estate and commodities returned less than 2% annually, while global infrastructure and natural resource equities returned just under 5%. With a decade of near-zero interest rates, fixed income was similarly challenged. Lackluster bond performance was driven by the low starting point of rates following the global financial crisis and the sharp rise in interest rates since 2022. Now consider the 10 years that ended in 2010. It's a stark contrast. During that decade, equity markets were the worst performing asset class, with barely positive total returns. Private markets were also substantially weaker and registered higher volatility. Conversely, U.S. Treasury returns and listed real assets were standout performers. As you can see in this chart, assets that performed well between 2000 and 2010 fared worse in the last decade and vice versa. It's easy to become enamored with what has worked best recently. It's challenging to resist FOMO, or the fear of missing out, which is why many investors tend to stick with what's worked in the past, expecting it to work in the future. But it's common to see reversals of fortune. Returns are often mean reverting, with starting valuations being key to future performance. And that leads me to today's markets. Recent market leaders, including equities and private markets, now face more headwinds. Recent laggards, notably for our firm, including real assets, have tailwinds. Indeed, equity markets increasingly depend on the fate of a handful of stocks, which now make up more than 30% of the broad index. Valuations are at historically high levels, and stock-bond correlations are near 50-year highs. Private markets may also struggle with higher interest rates impacting valuations and investment returns. Private equity investors may be unable to leverage their investments at ultra-low interest rates or to find favorable exits, while tight credit spreads could challenge private credit. In contrast, all core real asset categories are either neutrally or attractively valued, and we believe positioned for meaningfully better returns compared to the last decade and other asset classes. Plus, real assets can enhance portfolio diversification and potentially mitigate the impacts of inflation. We understand the pressures of FOMO, particularly when so many investors haven't experienced anything but a market environment in which rates were low, inflation was contained, and stock returns were so consistently strong. But we know from our experience that allocating by looking in the rearview mirror may be a recipe for poor future returns.